Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options S&P 500 U.S. market update. Boy, last time I was talking to you, we just had that killing of the Iranian general. The futures were down huge, but then the market came back and shook it off. We knew there'd be a retaliation from Iran, and there was, although they fired a bunch of missiles and didn't hit anything. And when they shot the missiles and the news came out, the futures went down big again. But then the news started to come out that there were no U.S. casualties. The market shook that off and moved back to the upside as well. Unfortunately, they did shoot down a civilian plane, which everybody knew they did. They finally came out and admitted it, and now there's a lot of protests over there, similar to what was going on in Hong Kong. So whether that'll create any further unrest in the Middle East, who knows? I doubt the market will really worry about that too much either. Let's take a look at the charts. So here's a chart of the S&P 500, and as you can see, we're nearing that C wave extension level of the 161.8% wave C extension. You've seen it before, so I don't think I need to draw out the wave count again. You can look at past recordings if you'd like to see it a little closer, but we're nearing that area, and an extended wave C is probably about as far as we go here, I would imagine, and the move to the upside, in addition to the fact that we're right at a wave 5 extension that's just in the 100% area, which means the wave 5 is the same length as the wave 3. Normally the wave 3 is the longest and strongest. If you have any familiarity with Elliott wave, you're already familiar with that. So we've got a couple things of major resistance working here, and we'll see if that is enough to create a correction of some sort of magnitude other than what we saw back at the end of December, which was really just a couple days long. Looking at the VIX is back down in that area of support right around 12. You can see every time we come down there, we tend to move just a little bit back to the upside, but we do have a large descending triangle, which I think bears watching as well. And you may think, well, do those type of patterns apply to the VIX? Well, they do. And so when we've had triangle patterns before, it's yielded a breakout. Now remember, it doesn't guarantee that the breakout's going to be to the upside. We could break out to the downside. We don't have a whole lot of room to move to the downside. We could go down to that 9 level where we were a year or two ago, but we could easily find some more volatility coming back into the market, especially if we continue just up enough to hit that 161.8% extension. I thought I would update you on the chart of TBT interest rates. So you can see that the interest rate chart there is showing that we're probably going into a flat. We had the wave 4 come down to the 61.8% level, and with this sort of a pattern here, it looks like the beginning of a flat. That's actually good for the equities market. As I've pointed out in the past, you don't want to see interest rates go too far to the upside, and you don't want to see them go too far to the downside either. So kind of in this sweet spot is a good place for interest rates as far as a potential move back to the upside. Looking at the dollar, we had a wave 5 that came down. This is pretty interesting here because we had a 50% correction in the wave 4. So if that was a zigzag pattern, you would normally be looking for 100% extension in the wave 5. But the 5-wave pattern doesn't have the exact same rules as the corrective patterns do. So we came down here, we hit this wave 5 Fibonacci extension right at the 61.8, 62% level. When that ends, normally you're heading back to the previous 4, and when you go back to the previous 4, now you usually start a new pattern. So we've done that. Be interesting to see what happens with the dollar. Not unusual to see this move back to the upside, especially with the unrest in the Middle East and the futures all over the place basically last week. A little bit of safe haven, I think, with money moving into the US dollar. I also wanted to show you a chart of oil. We don't show that very often, but here's a chart of light sweet crude, and you can see it's in a corrective pattern. We had a big impulse A wave here, and obviously that has to do with what was going on in the Middle East. And then when the horrific news came out that Iran had actually shot that plane down, and the protests that are going on, we'll see if that creates any more of a move back to the upside. But that move higher was short-lived, and we came all the way back down right to where this consolidation had been. back in November and December. I don't think that the protests will have much to do with oil, but we'll play that out. One other thing that I wanted to show you, we talk about the DMI a lot at Elliott Wave Options because that's one of our primary confirming indicators along with Elliott Wave. But we also look at an indicator called the CCI. And it came from the commodities markets, but now it's used in equity markets and other sort of securities as well. I'm going to go ahead and take off the Fibonacci retracement and extension patterns here just so you get a little clearer picture. And I wanted to show you that with this move to the upside, I think you can clearly see the pattern that we had here of higher lows out of the CCI, and note the corresponding points with the market where that occurred. So we came down here and it looked like at the beginning of August that we could possibly have a big move to the downside, but that was a peak lower and it was all the way down, as you can see, to the -3, -400 level, which is well below. Usually it runs between 0 and 100, and 0 and -100 is the average range. So anything above 100 usually is giving you an extended move to the upside. Anything below -100 is a little bit of an extended move to the downside. And just like all indicators, there's more intricacies to it. That's just a generality that I mentioned. But with any other indicator alike, when you find divergences, that is helpful, and it is with the CCI as well. So we came down here, and the question would be clearly, well, are we going to come down and break those August lows in the market? So even if you weren't looking at Elliott Wave or the zigzag pattern or anything else and just looking at the chart itself, once we started back to the upside here, if you saw that we had a higher low made in the CCI, it would give you confidence to stay long. And then obviously we had a little bit of an uneasy time when we had this move to the downside right at the end of November and the beginning of December. Clearly you'd be worried, is this going to be a December like last year where we had a big move to the downside? But then as soon as we recovered and started back up, you can see that once again, a higher low in the CCI, and it would have given you also confidence to stay long as we moved higher. So now we're getting to the point where even with this little dip here that we had with the uneasiness and unrest in the Middle East over the last week, we just made another dip there, which was another higher low, and we've continued to move to the upside. So you're getting these divergences out of the CCI, which have given you or could have given you confidence to stay long. So we like to do education along with our market analysis and help people understand the indicators that we're looking at so you can utilize them in your own trading. Don't forget to give us a like. Take care, everybody. Talk to you next time.